Welcome everybody. Bob Key and John Momartz here. Want to give you an economic update and our thoughts going forward for 2025. Today is January 20th. What we want to do today is give you our thoughts on where the market is today, some thoughts on the U.S. markets versus the international markets, why we added international last year, and now we're going to pull back a little bit on that, or have already this year. Talk about the valuations between the large, mid, and small cap asset allocations, and finally talk about where we see the market this year versus Wall Street analysts. So with that, Bob, do you want to take it from there?
Sure. So, John, you and I have certainly spoken a lot about this, and we've written a lot about it to the investors about why we feel the U.S. is a more profit-oriented economy, and because it's a more profit-oriented economy, that comes through into higher earnings, and the economy tends to grow faster, and earnings are higher, and the stock market tends to outperform. It's definitely a minority view that we have, unlike the consensus view of it's a global economy and everything kind of evens out over time. We believe there's a systematic reason why the U.S. continues to outperform. And really, when we're writing about this, most recently, we referenced the tale of two worlds, but we said it's a tale of two economies. And again, you just see the U.S. cranking along here at 2.7%. Well, really, the rest of the world is flat. And so economic growth continues to come out of the U.S. and continues not to come out of the rest of the world. And that goes through to the earnings. This is just to take the world stock market, right? And the blue line is when you take the U.S. out, and the red line is the U.S. And so these are the forward PE ratios. The thing that is alarming and why we somewhat reluctantly start to increase international exposure was you could see that international stocks are trading at 14 times earnings, while U.S. stocks are trading at 23 times earnings. So international stocks are very much cheaper than U.S. stocks. The question is that, does that mean they're less expensive, we should buy them, or is there a reason for that? And that's, as we go forward, look at earnings, we'll see the reasons why. So U.S. earnings, corporate earnings, and when you're buying a stock, that's what you're buying, the corporate earnings, just continue to grow at these rates that are so far beyond the international economies. Right now, the red line represents the consensus 1-year forward earnings. The blue line represents actual earnings. So when we look right now, earnings are expected to grow at about 16% now again over the next year. All things being equal, so if valuation stayed equal with where the U.S. market is, that would imply a 16% return on the S&P 500. So this chart here is just going to show MSCI forward earnings, the U.S. again versus the All Country World Index. So as this line goes up, it just shows that the ratio that the U.S. is producing from an earnings perspective relative to the rest of the world, it is producing the vast majority of the world's earnings right now, and so we continued. We've always had a systematic underweight to international, and then most recently we pulled back that underweight and so we're really very much overweight U.S. stocks versus international again. And this pretty much says it all, right? These are the forward earnings that we just talked about, the consensus analyst forward earnings. The purplish line there that's going into orbit is the U.S. That's what the U.S. companies are doing. The rest of the lines are the rest of the world. So when we look at those earlier, that valuation chart showing the U.S. has a higher price to earnings multiple. Is there a reason for it? Yes, this is the reason. You go back back to 2010, so the last 15 years now. You don't see a whole lot of earnings growth in the rest of the world, and you just see the U.S. continuing to explode in their earnings growth. So the U.S. has been the growth engine of the world. When the U.S. economy is growing and the rest of the world is not growing, one of the things that happens is capital investment flows towards the U.S. So on top of the additional growth, the U.S. dollar continues to strengthen against foreign currencies, right? People are selling their currency to buy U.S. currency, the U.S. dollar, to invest in U.S. assets. So when you own international securities, you own those in their local currency. If the U.S. dollar is strengthened against those, that's going to be a detriment to any international investing. So we want to, that's another reason why we just wanted to remove our international exposure. Now, this is breaking down the large, mid, and small. And the reason why we're breaking these down is that you can see, large and mid cap US stocks are actually very reasonably priced. It's just the large caps, which are expensive. And the reason why they're expensive, we'll get to in a moment, but those are trading at 22 times earnings. Well, large and mid are close to, trading close to 16 times earnings. The reason the large caps are more expensive is because that's where all the earnings are coming from. And here's the reason why. There's about 8 stocks out there, and we can see on the bottom of this chart, Amazon, Apple, Facebook, Microsoft, etc. They are the ones that are producing all the earnings. These big tech stocks and tech in general are just producing fantastic earnings. And we're seeing this is the growth rate of these earnings. So I mean it's just they're growing at 30+% a year right now, and that's just an incredible growth rate for earnings. We've been kind of out there on our own little island the last couple of years. We've been by far some of the more bullish people. A lot of people calling for recessions. A lot of big investment banks have been calling for recessions, and rather horrendous stock returns, down 15-20%, more than that, bear market returns, etc. We've been very bullish because we've said over and over, we don't see a recession coming. Recessions are generally caused by these credit contractions because credit was not overly expanded since the 08-09 credit crisis. Lending standards are much tighter. We thought the Fed could go through this tightening period without creating a recession. So what's interesting as we get into this year, we always we're a little strange in this way, but we always get a certain level of comfort feel when we're not with the consensus. And then this year, for the first time in several years, we are with the consensus. Our forecast is right in the middle of the range. I think we're at 65-75. That represents about a 12% return on the S&P 500, which is about consistent with where it's a modest estimate of where earnings growth will be with a slight contraction in PE. We look out over the last few years, I mean, it's astonishing just how bearish all the big investment banks were. This is 2023, and if we flip forward to 2024, we'll see the same type of numbers that, they just really, the S&P, the S&P is the red line. Look where that line is, and look at where everybody, all the forecasts were for the end of this year. I mean, S&P closed at 6,000. And look where all these investment banks are. We obviously had a much more bullish forecast, but even our very bullish forecast was still not bullish enough. Although we'd be at the top of this chart, we still wouldn't have been as bullish as what the S&P actually ended up returning. And this is the lesson we always say: is everybody, a lot of people talk about the risk of being in stocks. When we talk about portfolio construction, we talk about proper risk management, being prudent in your portfolios. This is a critical point here. The stock market is now up, 64% over the last couple of years. A lot of these, media types, or even, people in our profession have held their clients in cash or advised being in cash. And it's just, it's so detrimental to wealth accumulation to be in cash. It's not always about what you lose when stocks go down. It's about the missed opportunity cost here. This is catastrophic if you've been in cash for the last couple of years. So yes, we've been bullish. Yes, it's paid off well for us. But even if we were bearish, you would never have seen us go all to cash or get overly bearish to the point where you didn't participate in a good amount of this rally. It's something that we always have to keep in our minds, that especially as we people get different emotional opinions about what's going on in the world, et cetera. But, we have to stay exposed to these markets at some level. It's fine. You have to understand the error that's in all forecasts. So even though you're bearish, at some level, you don't go completely to cash. Even though you're bullish, you don't go completely 100% to stocks for this reason. But either way, it's certainly been a very good couple of years. And it's rare for the stock market to have 3 straight years of double-digit gains, but that is what we're calling for this year.
Thank you, Bob. And I would add that, yes, we are very optimistic and bullish on this year, but we do have a new administration coming in today, and they're going to start changing some of the rules of the game. So that is going to create some volatility in the market. It's not going to be a straight up run this year. So it will be up and down. Be patient. We're going to try to allocate you as best as we can. We expect, all things being equal, this to be a pretty good year. So with that, if you have any questions, please reach out to us. We've got meetings coming up with many of you, so feel free to ask your questions, and we'll just try to keep you current on where our thinking is. But thank you all.
Thank you, everyone.